Hello everyone and welcome to this presentation on the CFA Level I exam for June 2014. In this presentation, we look at financial reporting and analysis section of the exam, specifically reading 22, which is an introduction to financial statement analysis. In this video, we'll look at the main concepts of this reading and then look at some practice problems to verify our understanding of the material. There are 6 learning outcomes of this reading. We first look at the roles of financial reporting and financial statement analysis. We then look at the role of financial statements in evaluating a company's performance. We look at the importance of financial notes and what they mean. We then look at the different types of audits and their importance. We look at some of the information sources that analysts use other than the financial statements. And finally, we look at the 6 steps in the financial statement analysis framework. Let's start with the first learning outcome, which is looking at the role of financial reporting and financial statement analysis. Now, why do we need to do financial statement analysis? Imagine that we want to buy the stocks of Apple Corporation. Before doing so, we might want to look at its financial statements to see whether the stock is undervalued, fairly valued, or overvalued. Similarly, if you wanted to buy the bonds of Apple Corporation, we might want to check out its financial statements to see whether the bonds are undervalued, fairly valued, or overvalued. Companies report financial information through their balance sheet, statement of comprehensive income, cash flow statement, statement of changes in equity, and footnotes to the financial statements. In this presentation, we will look briefly over all of these financial statements, and we will use the actual financial statements of Apple Corporation for illustrative purposes. However, as the title of this reading states, this is only an overview chapter. The details on these financial statements will be covered in subsequent readings. Let's move on to the second learning outcome, in which we will look at the role of the key financial statements in evaluating a company's performance. In the next several slides, we will look at different kinds of key financial statements. Let's start by looking at the balance sheet. The balance sheet provides information on the assets, liabilities, and equity of a company as of a particular date. Assets are all the resources controlled by the company that it expects to provide benefits in the future. The most obvious example would be cash. Another example would be inventory. These are the items the company expects to sell to generate revenue in the future. The balance sheet also provides information on liabilities. These are the claims by the non-owners on the assets of a company. An example would be debt issued by the company. And finally, a balance sheet provides information on equity, which presents the interests of the owners in the company. In order for the balance sheet to balance, assets must equal the sum of liabilities and equity. Now let's look at the balance sheet of Apple Corporation to see how companies report this information in practice. Here's the balance sheet for Apple Corporation as of September 28, 2013. All the figures in this balance sheet are in millions, except for the number of shares, which are in thousands. Apple starts by reporting its assets first, starting with its most current assets, such as cash, short-term marketable securities, and other current assets. Its total current assets totaled about $73.3 billion. Apple then provides information on its long-term assets, such as the long-term marketable securities and plant, property, and equipment. Its total assets, both current and long-term, totaled $207 billion. We then have information on liabilities and shareholders' equity. We first have information on current liabilities such as accounts payable and accrued expenses. Total current liabilities were about $43.7 billion. We then have long-term liabilities such as long-term debt. Total liabilities, both current and non-current, were about $83.4 billion. Finally, we have information on shareholders' equity. Total shareholders' equity for Apple Corporation was about $123.5 billion. Total liabilities and shareholders' equity was $207 billion. This is the same as the amount of total assets reported above, right here. As we saw earlier, total assets equal total liabilities and shareholders' equity. Now let's look at the income statement. The income statement provides information on the revenue, expenses, and the income of a company for the financial period. It tells us how profitable the company is. Let's look at the income statement of Apple Corporation for an example. Here's the income statement for Apple Corporation for the year ended September 28, 2013. All the figures in this income statement are in millions, except for the number of shares, which are in thousands, and there are some per share amounts. Now this is just an introductory reading, and we'll be covering the financial statements, including the income statement, in detail in later readings. So we'll see what items such as net sales, cost of sales, operating expenses, diluted earnings per share mean. But for now, just get familiar with how this information is being reported. We can see that Apple had net sales of about $171 billion. Cost of sales was about $107 billion. Operating expenses totaled about $15.3 billion. The operating income was almost $49 billion. The net income was about $37 billion. And the earnings per share was about $40 for basic, and diluted earnings per share was about $39. Or rather, it was $39.75. Now, it is important to note that not all types of income are included in net income reported on the income statement. Net income excludes other comprehensive income, or OCI. OCI is the income from transactions such as changes in currency translation. If we want to look at all types of income, if we want to look at all income sources, we need to look at comprehensive income, which includes everything except transactions with owners. Now, transactions with owners, such as dividend payments or new issuance of equity, is never considered a part of income. Comprehensive income is the sum of net income and OCI. Let's continue with the example of Apple Corporation. Let's say Apple were to face a huge loss on its foreign currency transaction. That loss could potentially bankrupt Apple. OCI can therefore be very significant to a company's operations and must be reported. Under the International Financial Reporting Standards, companies have two options of reporting their OCI. They can either report OCI as part of a single statement of comprehensive income, or they can produce two reports, the first displaying the net income, and then a second statement which begins with this net income and reports the components of OCI. The US GAAP provides yet another option. Companies can report their OCI as a column in the statement of shareholders' equity. Under the US GAAP, companies can use either of the IFRS options or use this third option. Now let's take a look at the statement of comprehensive income for Apple Corporation. Here is the consolidated statement of comprehensive income for Apple Corporation. You can see that they're using the second option under the IFRS or the US GAAP, which is to start with the net income from the income statement and then report the components of OCI. Total OCI for Apple Corporation was negative $970 million, which means that they had other comprehensive loss in the amount of $970 million. We can also see that total comprehensive income is the sum of net income and total other comprehensive income, or loss in this case. The next major component of financial statements is the statement of changes in equity. This provides the beginning equity, any increases or decreases in equity during the period, and the ending equity balance. Equity can increase due to income, which is good, or equity can increase simply because of issuance of new equity, which is usually not the best because that dilutes the ownership of current owners. Similarly, equity can decrease due to losses or repurchase of previously issued stock. Now let's take a look at the statement of changes in equity of Apple Corporation for an example. Here's the statement of shareholders' equity for Apple Corporation. All the figures in this statement are in millions, except for the number of shares, which are in thousands. The amount of total shareholders' equity is given in the last column. The balance as of September 29, 2012 was $118.2 billion approximately. Now this is the beginning balance for 2013 fiscal period. We can see that net income increased shareholders' equity by about $37 billion, and other comprehensive loss decreased equity by about $970 million. Other components such as dividends and repurchase of common stock also decreased the shareholders' equity, and tax benefit increased shareholders' equity. The ending balance as of September 28, 2013 was about $123.5 billion, which is an increase from the beginning amount. The next major financial statement is the cash flow statement, which provides information on how the company is generating and spending its cash. The income statement that we saw earlier provides information on the profitability of a company, but it doesn't tell us how much cash the company is generating through those sales. As an extreme example, if a company were to make all of its sales on credit and never converted those sales into cash, it will go insolvent very quickly. Clearly, the cash flow statement provides vital information about a company's financial health. The cash flow statement breaks down cash flows into three categories. The first category is the operating activities. Operating activities represent the day-to-day business operations of a company. In the case of Apple, this would be the sale of iPhone, for example. Next category is the investing activities, which represents acquisition and disposal of long-term assets, such as plant, property, and equipment. And finally, we have financing activities, which represents obtaining or repaying of capital. For example, we could have long-term debt. Now let's take a look at the cash flow statement of Apple Corporation. Here's the cash flow statement for Apple Corporation. It tells us that Apple's beginning cash balance for the year September 28, 2013 was about $10.7 billion. The cash flow statement then provides information on operating activities, investing activities, and financing activities. Total cash generated by operating activities was about $53.6 billion. Total cash used in investing activities was about $33.7 billion, and total cash used in financing activities was about $16.37 billion. Total increase in Apple's cash balance for this year was about $3.5 billion, and its ending cash balance was about $14.259 billion. Let's move on to the third learning outcome, which looks at the importance of financial notes and management's discussion and analysis. Two companies with identical economic circumstances may end up providing very different information on their financial statements. The financial notes, also known as footnotes, tell us about the assumptions behind the preparation of those statements. Some of the items for Apple Corporation in their financial notes are that the statements were prepared in accordance with the US GAAP. We know about the use of Apple's financial derivatives to manage its foreign currency risk. We come to know more about its patents, commitments such as warranty, as well as other commitments that do not show up on Apple's balance sheet. Another piece of useful information is the management's discussion and analysis. It is the management's perspective on the company's performance, and it also talks about where the management expects the company to go in the future. This section is typically unaudited. In the United States, public companies must talk about certain items. For example, they must talk about significant trends affecting the company. Apple talks about the aggressive pricing in its industry. Companies must also talk about off-balance sheet obligations, which amounted to $26 billion for Apple. And finally, public companies must also talk about critical accounting policies that require management's judgment. Apple talks about its revenue recognition principles. The financial statements of public companies are generally required to be audited by independent accounting firms. The audit report provides reasonable assurance that the financial statements are fairly presented. Now, there are no guarantees that these statements are perfect, but it tells us that it is highly likely that the financial statements portray an accurate picture of the company. Now, there are three kinds of audit opinions. The unqualified opinion tells us that the financial statements are fairly presented in accordance with the accounting standards and that the financial statements are completely reliable. Next, we have the qualified opinion, which tells us that by and large, these financial statements are prepared in accordance with the accounting standards, but there are some exceptions. And finally, we have the adverse opinion, which tells us that these financial statements are completely unreliable. We would always want to see the unqualified audit opinion on public statements. Let's talk about the fifth learning outcome, which talks about sources of information other than financial statements that analysts typically use. In addition to the financial statements, public companies also provide other sources of information. For example, they provide proxy statements to their shareholders on matters that require voting, for example, the election of board members. Public companies also provide interim reports, generally on a quarterly basis, to discuss their performance. However, unlike the annual financial statements, these quarterly reports are typically not audited. Public companies also issue press releases and arrange conference calls to discuss their earnings with analysts. We are now at the sixth learning outcome of this reading, the final learning outcome, which talks about the 6 steps of the financial statement analysis framework. How do we analyze all the information reported on the financial statements? The CFA curriculum talks about 6 phases of the financial statement analysis framework. It starts with articulating the purpose, collecting data, processing data, analyzing the processed data, developing and communicating conclusions, and following up. We'll now talk briefly about each of these steps. The first step is to define the purpose of the analysis. Why are we even doing this analysis? Are we an equity analyst? Are we a credit analyst? Are we on the sell side? Are we on the buy side? The purpose of the analysis affects many things, such as the research methodology, the data sources that we want, and the reporting format of our results. At this stage, it's also very helpful to know your audience and to compile a list of questions that we want answered through our research. The next step is to collect data to answer the research question. A key part of this step is to obtain a strong understanding of the business and obtain information on the economy and the industry in which the company operates. The next step is to process the data. In order to process the data, we can use a variety of methods, such as the Monte Carlo simulation, sensitivity analysis, or any other method that we think is appropriate. In this step, we also read the financial statements, make any adjustments if necessary, compute financial ratios, and prepare common size financial statements. Common size financial statements are expressed as a percentage instead of giving dollar amounts. The next step is to analyze the data. We have to understand our answer. What did the data tell us? For example, suppose that we were thinking of buying the stocks of Apple Corporation. And let's say our analysis suggests that the intrinsic value of Apple's stock is $600. and intrinsic value. And the current market value is $550. According to our analysis, the stocks of Apple are currently undervalued in the market. The next step is to convey the findings of our analysis through our recommendations and conclusions. In the example of Apple, where the intrinsic value was $600 and the market value was $550, our investment conclusion would be that the stock is a buy. We might also talk about the earnings projection. We might say that we expect the earnings per share, EPS, to go up in the future, and that we expect the stock price to further appreciate. We might say that the stock price might go up from $550 to $700. The final step is to follow up on our analysis. Things change, and sometimes they change very quickly. We would want to go back to our analysis and see whether it is still valid. In the case of Apple, has competition increased by companies like Samsung, for example? Has Apple launched a new product which is expected to further enhance its EPS? Is the stock price still below the intrinsic value, or is the security currently overvalued? As part of following up, we might have to go back and perform all of the 6 steps of the financial statement analysis framework again. Now this brings us to an end to the reading material for this chapter. We will now go over some practice problems to check our understanding. Let's look at the first problem. Which of the following items would be reported in comprehensive income? Now we know that comprehensive income includes all changes in equity except for the transactions with shareholders. Now proceeds from issuance of new equity, that's a transaction with shareholders, so this cannot be part of comprehensive income. Dividends paid, again that's a part of transaction with shareholders. Gain on foreign exchange transactions, that's the right answer because it's part of other comprehensive income, which is also part of comprehensive income. So this C is the correct answer. Next question. Analysis of public financial statements is least likely to benefit creditors, stock investors, or managers of the company issuing those statements. Public financial statements are generally meant to benefit people from outside the company. And that is because managers of the company already have access to the internal records of the company. And therefore, it is least likely to benefit the management. Creditors and stock investors can rely heavily on these public financial statements for the purposes of their analysis. Next question. The basis for preparation of financial statements can be found in, well, as we saw earlier, the auditor's report provides credibility to the financial statements. It tells us whether the financial statements are reliable or not. It does not talk about the basis for preparation. Management's discussion and analysis. As we noted earlier, it is the management's take on the business, how it has performed. Most of the information in this section is unaudited. This does not talk about the basis for preparation. It is the financial notes where we get information about the assumptions used in preparing the financial statements. The final question. Obtaining an understanding of the business is a key part of which step of the financial statement analysis framework? Processing the data involves computing ratios and conducting simulations. We use the results for analyzing the data. However, before we begin processing the data, we need to have a strong sense of the business and the industry in which the company operates. Understanding of the business is a key part of collecting the data and not of processing or analysis. Now this brings us to the end of this presentation. I hope you found it useful. Thanks for watching, and I wish you the best of luck.